From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and welcome to today's episode of the Macrocast. I'm your host, Ylan, a managing director at Penta. In the driver's seat with me today are my co-hosts Brendan Walsh and Jon Fagan of Markets Policy Partners. And we've got a special guest along for the ride today, Jon Hilsenrath, former correspondent for the Wall Street Journal. And if you follow the Fed, of course, you know who he is. He spent more than 2 decades at the Journal covering economics and finance and was a finalist for the Pulitzer Prize in 2014. He's also the author of the book Yellen, the Trailblazing Economist Who Navigated an Era of Upheaval. Jon, thank you so much for joining the crew.
Ylan, you called me a special guest. I was hoping you'd call me an old friend. I remember sitting around in the Jackson Hole Lodge waiting for Fed officials to come out of their morning breakfast so we could
we can buttonhole them.
And yeah, exactly. Get them to tell us what they were going to do in September.
Yeah, no, those were good times, and I'm glad that things have come full circle.
In fact, I remember seeing you sit under a bear. A giant
It wasn't a
bear.
live bear, just to be clear.
Yeah. It was a stuffed grizzly bear. Yeah. Typing away at your computer in your Washington Post days.
We were hard at work, and in those days, I think the Fed was obviously still at the zero lower bound, and we were all wondering if they would ever raise rates again. And now here we are. The Fed has raised rates at its last meeting to the highest level in 22 years. Chair Powell was clear that additional hikes could still be on the table later on this year. So. Yeah. Jon, what do you think went into that decision?
So, it's interesting. I was kind of talking about the old days. I was thinking about what's happening now as kind of like a reverse taper tantrum. So back when we were covering the Fed in the 2010s, the question was when are they going to stop easing policy? When are they going to stop doing these QE policies? And when they suggested that they were going to slow down their QE, the market freaked out because it was kind of needed that like amphetamines. Now it's in reverse. Now the Fed is talking about stopping raising interest rates, and the market's really excited. So it's kind of like the taper tantrum in reverse. The markets are off to the races now that the Fed's going to pulling the punch bowl away from the party.
Jon Fagan, what do you think? What do you make of the market reaction to the Fed's decision?
Yeah, I think the Fed really hit it down the fairway, right? And I think Chair Powell's press conference was very much the classic sort of two-handed economist, right? It was a much more balanced kind of statement. It was the emphasis was on meeting by meeting, data dependence. Now that's kind of something for the Fed. Maybe you can criticize them by saying that's very unspecific and they're kind of hiding behind that, but. I think it's a true expression of where the Fed is right now. And Chair Powell said a number of times, we've got 2 more inflation prints, 2 more labor market prints before the September meeting. We've got a lot of data yet to come, and that's going to give us lots of guidance as to what the next move is. And there's no preconceived notion. That kind of downplays the dot plot that we got, that hawkish dot plot that we got in June that, signaled 2 more rate hikes. That is, something that Chair Powell has in the past sort of downplayed, and I think that his commentary yesterday was similarly ambiguous, and I think that he wants to keep the market guessing. And as to Jon's point, the market is really getting excited here about the end of the tightening cycle, and to the extent that the commentary can keep the markets on their toes and keep that potential next hike. Whether it's September or November, that's something that, will be an important part of the Fed's communication strategy.
I kind of think what's going on right now is Powell is like a jockey on a racehorse, and he's holding the thing back because he knows that if he says they're done raising rates, then the market's going to take off, and he just doesn't want to fuel that kind of activity. That'll just kind of ease financial conditions, and he wants to keep them restrained. But if you look at the data over the last few months, I've been arguing that they didn't even need to raise rates at this past meeting. So we got GDP numbers today on Thursday. The PCE price index, which is what the Fed targets, rose at a 2.6% annual rate in the second quarter. The Fed is saying that it wants to get to 3.2% by the end of the year. It's already there. The Fed has been concerned about core inflation, ex food and energy. that was right in the second quarter where it says it wants to be at the end of the year. And so, if these numbers play out the way they've been playing, I think what Powell is going to do is he's going to let the data do the talking for him. They're going to see that inflation is on track to reach its objectives for the year, and that, I think they're not going to have to raise rates again. I think they probably didn't have to raise rates yesterday. If anything, there was maybe a mistake that they went too far. I found it interesting in the press conference that he was kind of entertaining these suggestions that the market expects them to cut in the next couple of years. And he didn't just totally dismiss that. And I also thought that he effectively went to neutral yesterday when he said in September, we might raise, but we might also not raise. He hasn't been talking that way. He's been talking in previous press conferences as if we have more work to do. We have more work to do. By saying, I don't know if we have more work to do, he kind of changed the balance of expectations.
So there's always a balance between what maybe the Fed should do and what the Fed ends up doing. And John Fagan, to your point around, what the dot plot was signaling, you would think that the Fed is assuming there's one more rate hike sort of baked in, but you're arguing, Jon Hilsenrath, that the Fed should have moved at this past meeting. John Fagan and Brendan, you guys have been arguing that the Fed would have been done by the middle of the year and then remain sort of stubbornly on hold. What is the argument for stopping when we see the economy still going so strong and we see inflation cooling, but not quite all the way down to 2%?
Not driving us into recession.
Yeah.
Why do they need to screw us?
Yeah, Powell,
to put it bluntly, Brendan.
Powell said a number of times that he's waiting for the full force of the tightening cycle has not been seen in the real economy, and the effects are still playing through. And that's part of that lagged effect. Is part of what makes policy making at the Fed level so hard, because you don't know to what degree is it fed through. That's a very challenging assessment to make. But everybody knows that there's probably still. He alluded to the tightening credit conditions after the Silicon Valley Bank. He thinks that that is going to, on the margin, crimp investment and business activity, and keep housing in a challenged condition. So this is the idea of you want to stop tightening well before you hit your target, because it's already on the glide path and the impact is already feeding through.
But John, I want to ask you this. So when I started my career in the early 2000s, a former Fed governor told me that the data doesn't matter. What matters is the Fed's projections. And this Fed could not be any more opposite. They just told you we're completely data dependent. Our outlook doesn't really matter. The dot plot is completely irrelevant. How much monetary policy has changed in 20 years?
I mean, I think the real time data informs how the forecast is going, and my former colleague Nick Timmeros mentioned this in the press conference. I think what could happen in September is those inflation forecasts for the first time in a long time could come down. And this gets to what you were saying, Ylan, that, why should they stop when the economy is going strong? Well, I mean, they have two objectives: low and stable inflation and low and stable unemployment. So if we're getting solid growth in an environment of low and stable inflation, that's great news. Like, that's the kind of Goldilocks news that we all dream of. They shouldn't be targeting a growth rate. They should be targeting an inflation rate. And we've been seeing, it's amazing to me, we've been seeing since last year. I wrote a story in September of last year that the inflation data were cooling. I mean, the inflation rate peaked in June of 2022, and anyone who's been paying attention has seen that. It's kind of amazing that we're only noticing now that it's gotten down to 3%. So there really is a cooling, and growth really did slow last year. We already had an inventory cycle. We already had a housing cycle. So I think the economy is coming into better balance. And the amazing thing is that it's happened at a period when unemployment didn't get hit really hard. So I mean, a lot of things could still really go wrong, but I think things are they're in a pretty good place right now. And the Fed is just this really inertial organization. You saw that when you were covering it. They take a long time to change path. And I think one of the risks that worries me is that they just went on with this tightening cycle too long. And let's not forget, in 2006 they went on with a tightening cycle too long, and we had a financial crisis that started unfolding in 2007. So we might not see the full effects of what they've done this time for another year or two. But right now things look pretty good. They seem to be shaping up pretty good for the second half of the year.
Well, one thing we've spent a lot of time on recently is the commercial real estate sector, and it's kind of a slow-moving train wreck. And it's partially, low rates, and partially we don't go to offices anymore. But is this something that you get a sense that the Fed it has an understanding of? Just kind of there's a potential of $1 to $2 trillion in losses out there, and that's really vastly held by small and regional banks, and then insurance companies, and also pension funds.
Yeah. Well, I mean, certainly the Fed pays attention to that. They've had a lot of experience with commercial real estate cycles, especially in the 90s. I think what the SVB crisis raises is, okay, so maybe they see things bubbling, but do they react to them in time to address them and stop them? And I think you have to take the lesson from the SVB collapse that the regulatory apparatus is not really kind of well tuned to stop a crisis before it happens. I mean, that one happened right under their noses. So yeah, I think commercial real estate you have to put down as one of the big risks to the banking system right now and potentially to the economy. Is it big enough to derail everything else? I mean, the optimistic side of me, says I hope not, and I think not. On the residential side, we might be coming out of the other end of a cycle already, where the home builders, because people aren't selling existing homes, they're locked in. Like I've got a really low rate on my mortgage right now. I'm not going to sell and move into a higher rate. So the builders are starting to build new stock, which is really something the country needs. The other wild card that I'm really focused on that I think is super important, that it amazed me because nobody talked about it. Nobody asked Powell about it at the press conference yesterday. But China is a huge story. It's the second largest economy in the world, and it's exporting deflation right now. They're experiencing deflation. U.S. import prices are falling. Even if you exclude oil, import prices are falling. Yeah. So we have this really strong headwind on consumer prices on the good side of the economy that I think is going to keep playing out and is really going to help the Fed in the second half of the year.
Yeah, and also to your point, the Fed's probably over tightening. Now they're focused on services inflation, but services inflation is always positive, and goods inflation is usually negative. So they're just kind of moving the goalpost, like. Yeah, you have to look at the whole thing. Not just,
I agree with you. This thing's super core. All of a sudden, people are now talking about super core. Like, where did that come from? And since when does it not matter? What you pay for, cars or televisions or your groceries. It's like I totally agree with you. I think the super core thing is kind of weird. For 20 plus years, education and health inflation. We're far outpacing the overall rate of inflation. So so now you're going to target that, and actually it just so happens education and health inflation have been slowing a lot. I think they say in their statement of objectives that their long-term objective is overall inflation, and it was 2.6 in the second quarter. So
let me play devil's advocate here for a minute and say, all right, if the Fed seems to be achieving that soft landing that everyone thought would be so elusive, that they've been able to, undertake the fastest tightening cycle in history, and yet the economy is still actually speeding up, economic growth is actually speeding up, the unemployment rate has stayed low. Why not sneak in one or two more rate hikes to give yourself more room to potentially maneuver if there's another black swan event or another crisis in the future?
I would say, first of all, they have a lot of room already. Mm-hmm. They're well over 5%. The market, the bond market, has said they're going to cut interest rates. So, I think I I think you manage policy according to where you think the economy is going and where, I mean, again, their objective is inflation. If inflation is coming in on this glide path, it's not even a glide path. It's fallen pretty fast in the last year. Then you manage to that. You don't manage into the next cycle when you think you might want to, cut rates again, or you might need to cut rates again. I think that just creates potentially more volatility. I think that, they said in June that they want to they expect to get to the low threes by the end of the year. And based on that forecast, they think they would need to raise rates 2 more times. Well, they're already in the high twos. So why do more? Mm-hmm. Like they're already there.
Mm-hmm. Take the win. Just take the win.
Well, this is what Powell's going to do. I think he's going to take it quietly. He doesn't want to wave the mission accomplished flag around. I think he wants to let the market figure it out, and then live up to the market's expectations.
I totally agree. Right now, it's really not about economics. He's worried that the market, both rates and equities, just go bonkers. So he doesn't want to give too much away.
Yeah.
And if that happens, that would sort of undo a little bit of the Fed's tightening, because part of what the Fed has argued is that, right, financial conditions are tighter, and so that's sort of feeding on top of the interest rate hikes that the Fed has already done. So if markets take off, then it's almost like they're cutting without cutting.
Yeah.
Well, it's also when you look at financial conditions, I mean they're loosening. We've seen the VIX come down a lot. We've seen the equity market running. If you look at the Chicago Fed National Financial Conditions Index, it's getting it's not completely loosey-goosey, but it's definitely looser in a loosening trend, and that's one of the things that the Fed is going to struggle to, if they're targeting inflation now and inflation sort of goes to where they want, they don't want it to, the genie to get back out of the bottle. And how could it do that if the markets really start to get excited about this end of the tightening cycle and start to rip? And that's the kind of, point where you have, that additional rate hike kind of in your back pocket, you can potentially deploy or certainly credibly threaten about it. And just, there's going to be potentially an organic tightening later in this year and into next year. If there is, a deterioration in economic growth and the Fed is denying the rate cuts that are priced in, there are 100 basis points of rate cuts priced in next year. Yeah, so signaling that is probably not going to be on the table and the Fed is not going to do anything close to 100 basis points next year, that realization would be represent a tightening in financial conditions.
There's another kind of organic tightening going on right now, which is that as inflation comes down and the Fed holds the nominal interest rate steady, real interest rates are rising. So the real cost of borrowing is going up. But to your point, Ylan, I think that Powell might be saying to himself, well, I can afford to keep them high for a little bit longer because everything else is going all right. Unemployment is really low, and the economy is still growing. So I don't have to rush into this next easing cycle that the market is projecting. I just want to throw out one other wild card out there that I think people are going to, maybe we'll wake up to over the next couple of months, which is the productivity story. And so to me, that's how things start adding up. It's how does this make sense, what's going on right now? Inflation is coming down. The unemployment rate is really low. We haven't had a recession. What's the key that holds all this together? I find it remarkable. First of all, second quarter, we had 2.4% growth in an environment where aggregate hours worked. So if you look at hours worked and employment was flat. So there was no increase in hours worked in the second quarter of the year. And if you actually add in a decline in self-employment, hours worked might actually have declined. We're going to get a really good productivity number for the second quarter of this year. And
it's AI, isn't it?
What? Pardon me?
It's AI, isn't it?
Well, I don't know what it is. That's a whole other story. But here's something that I just find remarkable. Through COVID, if you go all the way back to 2019, the productivity of American workers has increased at more than a 1% annual rate, and it increased at more than a 2% annual rate in the second quarter. So there are all these stories going around about quiet quitting. People aren't quiet quitting. They're getting their work done. And the productivity rate, like we went through this incredible economic shock, and the productivity, I mean, there's been a lot of volatility, but it kept rising. And that actually could explain why profit margins at corporate America is holding up, why they're not laying workers off aggressively, and inflation could be coming down. I mean, this is super Goldilocks, and I don't want to. It's kind of like I'm a reformed journalist. As a journalist, you're not allowed to be too kind of optimistic, but it's possible that we're finally starting to get some of these productivity gains that people. You say it's AI. I mean,
I was joking about AI,
yeah,
but maybe it's
there's
technology. We're now talking. Half of us are in person, half of us are on Zoom. You know, we're sort of working hybrid schedules. People are finding ways to work that fits their lifestyles, and therefore they can, work more. To be frank about it, but maybe that's part of it.
I say people aren't quiet quitting; they're quiet living, right? So it's like you're at home, you get your work done, and then you go throw a ball to your kid in the afternoon, and then you go back and get whatever other work you need to get done. I mean, just cutting out a commute, like how many hours does that add back to a person's life in terms of either living or working?
Increased productivity from less commuting.
Maybe. Who knows?
It's possible. I want to talk to you, Jon, about sort of Chair Powell's term broadly. How would you rate his job performance, and how would you compare his sort of style and leadership to that of now Treasury Secretary Janet Yellen, former Fed chair, who you've covered very closely and wrote a whole book about?
Right. Yeah, actually, rating both of their performances could be an interesting exercise. In terms of Powell, I would compare him to the gymnast on the balance beam. So, he's wobbled a few times and came really close to fall. In fact, you might say he's already fallen off the balance beam. I mean, he's been through it. Like when you look back at his term, coming in there with getting browbeaten by Donald Trump about how little touch he had and how he had interest rates too high and all this stuff, and then the COVID crisis, and like he really misread the economic dynamics behind the COVID crisis. It was a supply shock and not a demand shock, and he pumped too much money into the system, and like those are stains on his mark. But this is where the balance beam analogy comes in. If he sticks the landing, then I think he's going to go down with a pretty cool place in history, that he will have been the guy who defended the Fed's inflation fighting credibility, right? So in terms of people expecting that the Fed to stick to that 2% target, he will be the guy, because of his own mistake, who sent a message to the world that when they say 2% inflation, they mean it. So that could land him in a pretty good place in history after having some real ups and downs. Yet Yellen is kind of the opposite of that, in the sense that she had this stellar track record for so many years in Washington. And then she came along, although some conservatives might disagree with that. But, she was running the Fed at a time when the economy got back to a pretty good place, 2012 to 2016, or 2014 to 2018 But then
she actually hiked rates.
She did.
She got us off the lower bound.
She started it.
Yeah, she's viewed as a dove, and she's like, other than Powell recently, the only one that actually hiked rates.
Yeah, in all these years. But the stain on her record is the inflation we've experienced. So she might, if they don't get inflation under control, then she's going to go out having botched the landing. But if my optimism proves to be true, then I think it's interesting. I mean, I was going to say I think she'll leave after the first term, and if inflation gets back down, then she'll go out with a pretty decent record in the end. A lot of people thought she was going to be gone before or after the midterms, and I mean, I talked to her a bunch in writing this book, and she actually she likes the job. She really enjoys what she's doing and feels like she has this kind of important task at hand. So I expect her to leave after the elections in 2024, but Who knows? I mean, she might
well,
decide.
And also depending on who wins the election in 2024.
Yeah.
Right.
Good point.
I mean, I thought, one of the sort of moments in her career that I think is so fascinating is that everyone, there's this big debate about how political is the Fed. The Fed is an independent institution, et cetera. But, what we saw around Yellen's fight with Donald Trump, or maybe Donald Trump's fight with Janet Yellen, and the same thing with Jay Powell, is that the Fed is not insulated from politics by any means. Yeah.
They try to be, but they're certainly caught in the middle of it. The Trump-Yellen story is kind of interesting, So there were these reports going around when he was considering renominating her for a second term that he had kind of offhandedly mentioned to some of his colleagues that she was too short to be the Fed chair. I don't know if you remember those stories.
Oh, I remember.
So I talked to him.
And as a short person myself, I was
I am too.
Offended.
So I took some personal offense to this. But so I asked him. I talked to him in doing my reporting for the story, and I said, "Did you think she was too short for the job?" And he gave me kind of a bizarre answer. He was like, "I didn't even know she was short. Is she short?" I said,
"Maybe they met over Zoom."
I said, "Mr. President, I mean, she was sitting right in front of you. Like." Her feet might not have even hit the ground, but he liked her. He liked Yellen. I think he felt some New York City connection to her. She's a Brooklyn girl, and he was a Queens boy, and he thought that she was an easy money person, a low interest rate person. So part of him wanted to renominate her because he thought she would give him the low rates he wanted. But in the end, he felt like. He felt like he wanted to have a Republican who would be loyal to him. And he ended up getting Jay Powell, who wasn't.
Well, and I think it was former Treasury Secretary Stephen Mnuchin, right, who was the one who was really behind putting Powell in that job.
Yeah, and Trump never forgave him for that. Because let's not forget, Powell came in and kept raising rates. That's why there's this inertia to what the Fed does. Powell kept raising rates, doing something that Yellen had started, and he realized after a little while that he went too far. And Donald Trump was right. Donald Trump was telling him, "You're raising rates too much," and Powell turned around and started cutting rates in 2019. Which I thought was really interesting because he cut rates in a low unemployment environment. People are saying right now, well, he can't cut rates because the unemployment rate is so low and it'll overstimulate the economy. But he did in 2019. There was a lot of uncertainty about trade with China and so on and so forth. So it wouldn't be unprecedented for them to cut rates in a year or two if inflation comes down, even if the unemployment rate stays low.
You mentioned earlier, Jon Hilsenrath, the Jackson Hole conference that the Fed has every summer at the end of August, and nestled within the Grand Tetons. They convene to discuss.
Wow, you say that just like a Washington Post reporter would write that story.
Exactly. What do you think we'll hear out of Jackson Hole this year? I mean, is this the time for the Fed and for Powell to sort of set the stage to indicate that, the end of the tightening cycle is actually here? I mean, you said he's going to sort of let the data talk for him, but, he has a moment. He'll have the stage and he can, articulate perhaps a vision for what the Fed is going to do, over the next few years.
Yeah, that's really interesting. And Jackson Hole really has turned into this moment where every year, everybody in the markets tune in to what the chair says. As we were talking about earlier, I think he doesn't want to let the reins go just yet. I suspect he'll want to give some kind of update on kind of where things stand on getting inflation under control. And I think he'll kind of want to reassert the Fed's commitment to this 2% target and why they have it and, why it matters and where they stand in getting back to it. But I don't think he's going to want to declare an end to the tightening cycle because he doesn't want to get ahead of the market. He wants to come to where the data and the market lead him.
He's not going to plant a flag.
Yeah, I don't think so. And I was thinking before the meeting this week that maybe he would kind of say that further increases will depend on how much progress they make on inflation. They just decided to say as little as possible. and they're really letting the market figure it out. So, but I think it'll be an interesting time for him to say, okay, what just happened, and where do we stand in terms of the inflation cycle and the economic cycle?
John and Brendan, anything that you guys are going to be sort of keeping an eye out for in the Jackson Hole conference, and I guess about a month from now?
I want to ask John, there's obviously been a lot of turnover at the top of the Fed. We've seen lots of personnel changes. How do you think this changes the character, if at all, of what we're thinking, what we thought of as, the Powell Fed? There are just lots of new faces around him. Yeah. Do you detect any sort of philosophical shift that's being brought about by this kind of change?
That's a really interesting question. And my old colleague at the Journal, Nick Timmeros, and I talked a little bit about this. I was calling it the Biden Fed and not the Powell Fed because Biden is behind most of these, including Powell now, the people who have been there. And we've got people at the regional Fed banks like Austin Goolsbee, who's a Democrat, served for Barack Obama, now running the Chicago Fed. So it really does have this kind of Democratic Party imprint on it. And what I find so interesting is how unified the place seems. Like, Ylan, when you and I were covering it, Ben Bernanke was constantly, fighting with the hawks.
Bullard's gone
Fed.
now. Bullard's gone. So.
Well, Bullard, I wouldn't call him a hawk. He was kind of,
He's just a
I'm not sure what bird I would attribute to him, but he kind of flew in and out of different places. But there were no dissents. So here there's people in the market saying they should stop raising rates. And, and the 10-year Treasury yield suggests they're going to be cutting rates in a year. And there was no one standing up and saying, all right, enough is enough. Like, let's just let this play out, which doesn't mean they can't raise rates later. But I find it really interesting how unified the place is behind him. I think that the common denominator for them is they all recognize what's at stake in getting in meeting this inflation target. They fought so hard for so long to establish inflation fighting credibility, and I think nobody there wants to be responsible for losing that, which is why I've thought all along these analogies to the 1970s were nonsense. So, in the 1970s, the Fed had literally, it had no mass to pin itself to. Richard Nixon took the country off of a gold standard, which was the closest thing we had to a kind of monetary guidepost. And we went off of the gold standard. So there was no way for them, no orientation towards policy. But they have a very, very clear objective, and that's a 2% inflation goal. And so, all these questions, are we going to get to 2% inflation or not? Or we now live in, is it a repeat of the 70s? My view is that's all just a question of the Fed's credibility. When they say we're going to have 2% inflation, do they mean it or don't they? And I think that they are unified, even as they transition from a Trump Fed to a Biden Fed, in that 2% target. And for me, the only question is, when are they going to get there and at what cost?
And right now, it seems like they're sticking the landing. That the costs are not that high.
So right now, and don't you feel a little nauseous saying that?
I know.
Because something's obviously got to go wrong.
Something's going to go wrong. Yeah. Well, if and when it does, because life is long, we would love to have you back to talk about all of it some more. We really appreciate your time today, Jon Hilsenrath. That does it for us. I'm Ylan Mui with Penta. My co-hosts are John and Brendan from Markets Policy Partners. Again, thank you to Jon Hilsenrath for joining us. His book, one more time, is Ylan, the Trailblazing Economist Who Navigated an Era of Upheaval. You can find it on Amazon or in the show notes. We hope you enjoyed the show, and please remember to like and subscribe to the Macrocast wherever you get your podcast. Thanks for listening.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.